Good morning, and welcome to yet another edition of Macro Now, set to be released every Monday morning. Today is Monday, October 26, 2020. My name is Alexander Turro, Senior Market Strategist here at RJO Futures. We're going to be contextualizing the rates of change of growth and inflation, not only here domestically, but globally as well. So with that said, we'll start with the global currency market. You had the US dollar index down another 1.0% last week, breaking back down to bearish on a 15-day as well as a 90-day trend duration. The euro versus the US dollar appreciated 1.2% last week and remains neutral on a 15-day as well, but bearish on a 90-day trend duration. You had the Japanese yen up 0.6% versus the US dollar and remains bullish on a 15-day as well as a 90-day trend duration. You had the British pound versus the US dollar was up plus 1.0% last week and remains neutral on both a 15-day as well as a 90-day trend duration. And if you look at something like the Chinese yuan, that continued to appreciate another 0.2% versus the US dollar last week and remains bullish on a 15-day as well as a 90-day trend duration. That's fundamentally makes sense for the currency to continue to appreciate versus the US dollar, as China's economic data still continues to confirm an acceleration in real growth. Moving across assets, as the street continues to cheer for more stimulus on the back of the dollar devaluation, you have the reflation of the commodity asset class. As if you look at something specifically like corn, that continued to inflate up another 4.3% last week to plus 13.8% in the last month. Soybeans inflated another 2.8% last week, but are still down minus 6.1% in the last month. Natural gas inflated another 7.1% last week to plus 6.3% in the last month. And you have copper inflating another 2.1% last week and up 4.5% in the last month. What's interesting to look at, as I mentioned, with the dollar up this morning, commodities are broadly lower, with oil leading most losers, down minus 2.5% last week, as it could not hold the 15-day support, which came in last Friday at 40.38. Which has now been refreshed to 39.90. So it'll be interesting to keep an eye on that. Bond yields finally paid attention to U.S. inflation data accelerating. You had the U.S. 2-year yield was up plus 1 basis point to 0.16%. The U.S. 10-year yield was up a big 10 basis points to 0.84%. And then you had high yield spreads compressed minus 3 basis points versus treasuries to 468 over. And as opposed to being singularly focused on something like large cap U.S. growth, you want to, because if you take a look at something like tech, that was down minus 2.2% last week. The NASDAQ was down minus 1.1% last week. And Apple down minus 3.3% last week. Which comes on the heels of the meat of earnings this week on the pretenses of better than expected reporting, which if you look at something like Tesla was down minus 4.3% on the week on better than expected reporting, and Netflix, which came in worse than expected, was down minus 8.0% on the week last week. So continue to remain data dependent. Monitor the correlation risk with the dollar, as well as the volatility. And just as a side note, one last thing here with the front month VIX unable to break trend below 26. The VXN, the ticker for the volatility component of the NASDAQ, closed at 33.45. You could easily take a look at the high 30s again with the VIX upside risk to nearly 30. And that's on the heels of volume decelerating minus 8.0% on Friday versus the 1 month average. So, with that, that's all we have for you today. If you have any specific questions or would like to follow up, please feel free to reach out to me directly. Otherwise, thank you for listening and keep your head up out there.